Welcome in, everyone. I am absolutely thrilled to have you here for this explainer. Think of me today as your personal financial mentor. If you're a young professional and you're feeling a bit intimidated by the whole stock market thing, or honestly, if you just feel like your savings aren't working quite hard enough for you, well, you're exactly in the right place. We're going to strip away all that confusing jargon and look at exactly how to start investing backed purely by the numbers.
Okay, let's just dive right into this. We've got a clear 5-step syllabus for conquering the market today. We'll look at the cost of idle cash, the magic of compound interest, decoding those tricky financial metrics, navigating risk and FOMO, and finally, executing your very first trade.
Module 1. The cost of idle cash.
So a lot of people think that keeping their money in cash, maybe sitting under the mattress or hidden away in a closet, is the absolute safest thing they can do. But here's the harsh reality. Historically, the stock market has averaged a 10% annual return on investment. If your money is just sitting there as idle cash earning 0%, it's really only worth its face value. In the investing world, we actually have a saying, savers are losers. And why is that? Because while your cash just sits there doing absolutely nothing, the cost of literally everything else around you is going up.
And that, my friends, brings us to inflation. With inflation recently hitting around 8.5%, keeping cash idle mathematically guarantees that you are losing your purchasing power every single year. Think about it. If your mattress money is earning 0%, but the cost of milk, gas, and housing goes up by 8.5%, your money buys less and less over time. You are literally moving backward.
Module 2. The magic of compound interest.
Now, what's really interesting about this concept is that Albert Einstein famously called compound interest the eighth wonder of the world. He said, "He who understands it earns it, he who doesn't pays it." Compound interest is simply the interest on your initial deposit plus the accumulated interest from the previous periods. In plain English, it's your money earning its own interest over time. If you don't understand it, you're the one paying those massive credit card interest rates, feeling like you can just never get ahead. But when you do understand it and you apply it to investing, oh man, it does all the heavy lifting for you.
Let's look at what this actually means in real life. Take a look at the growth of $10,000 over time. Say you set a specific financial goal to just leave it alone and let it grow at the market's historical average of 10%. After 5 years, you have over $16,000. Fast forward to 15 years, you're looking at nearly $42,000. But look at year 30. By setting specific long-term goals and just playing the long game, that original $10,000 turns into nearly $175,000. That is the true power of letting your money work for you.
Module 3. Decoding key financial metrics.
Now, as your tutor today, I have to give you a quick warning. Please do not just buy a stock because it sounds popular on social media. You have to understand the underlying math. The very first metric to grasp is market capitalization, or market cap. Think of a company like a giant pizza, right? Buying a stock is like buying a single slice of that pizza. Market capitalization tells us the total value of the entire pizza. You calculate it simply by multiplying the total number of slices, so the shares outstanding, by the cost of each slice, which is the current share price. This is exactly how we categorize companies into small, mid, and large caps.
But obviously, just knowing the size of the pizza doesn't tell us if it actually tastes any good, right? So how do we evaluate a company beyond just its massive size? How do we know if we're actually paying a fair price? Well, for that, we use the price-to-earnings ratio, or PE ratio. This is a valuation metric. You simply take the current share price and divide it by the earnings per share. This is super helpful because it allows us to make an apples-to-apples comparison of a company's stock value relative to the actual profit it generates. It anchors the math to real-world value so we can quickly see if a stock is trading at a massive premium or if it might actually be an absolute bargain.
Another fantastic metric is return on assets, or ROA. You figure this out by dividing the net income by the total assets. So the crucial point here is that this ratio pulls back the curtain on the company's management. It reveals exactly how efficient they are at using their current resources to actually generate earnings. A high ROA means management is a well-oiled machine. A low ROA means they might be kind of wasting their resources behind the scenes.
Module 4. Navigating risk and FOMO.
So investing always involves some risk, but remember this golden rule. As investors, we absolutely must be compensated for the level of risk we take on.
Now, you're going to face several types of risk. There's market risk from broad economic shifts, liquidity risk where you might not be able to sell an asset quickly, and inflation risk, which we already talked about. But a massive one for beginners is concentration risk. Listen, if you put 99% of your net worth into just one single stock, even a genuinely great one like Tesla or Apple, you are putting all your eggs in one basket. That leaves your portfolio totally vulnerable to a single point of failure.
To combat that, I always recommend building what I like to call a SWAN portfolio. SWAN stands for Sleep Well at Night. You achieve this through diversification, spreading your investments across different sectors and asset classes. Proper diversification protects you against unexpected market volatility, ensuring you aren't, staring at the ceiling at 3 a.m. worrying about one single company's earnings report. And part of sleeping well at night is also avoiding those rookie emotional traps. The biggest one? FOMO, the fear of missing out. Seriously, do not act on locker room stock tips. Do not smash the buy button just because an industry is trending on the 24-hour news cycle. Impulsive trading based on FOMO is a surefire way to lose your shirt. Seasoned investors set specific, attainable financial goals, and they rely on structured math and research, absolutely not fleeting emotions.
Module 5. Executing your first trade. Let's move to the execution phase and see how this all builds together. Here is a simple, stress-free checklist for actually buying a stock. Step 1. Open and fund a digital brokerage account. And honestly, platforms with $0 commission fees are totally the norm now, so that's easy. Step 2. Search for your company's ticker symbol, like AAPL for Apple. Step 3 is vital. Select your order type. And Step 4. Execute the trade. Oh, and a mentor pro tip for you. Once you execute, set up automatic recurring investments. It is the ultimate hands-off benefit for guaranteed long-term growth. Now let's just pause on Step 3 for a second. Because when you go to buy, you'll generally see two main options. A market order executes immediately at whatever the current fluctuating market price happens to be. It's totally unpredictable. As a beginner, you really want to use a limit order. A limit order ensures you only buy or sell at your exact specified price or better. It basically acts as a shield, protecting your entry price and keeping you safe from sudden, unexpected price swings during the trading day. Finally, when you eventually sell and make a profit, you really have to understand the tax implications. If you hold a stock for less than 1 year, that's considered a short-term capital gain, and it gets taxed at your higher regular income rate. But if you hold that stock for over a year, it becomes a long-term capital gain, and this is huge because the government actively rewards long-term wealth building by taxing these gains at a much more favorable rate, anywhere from 0 to 25%. Well, we have covered a ton of ground today. From beating the stealthy tax of inflation, to letting compound interest work its magic, to understanding those core metrics so you can make smart, calculated decisions. So the only real question left is, are you ready to stop letting your idle cash lose its purchasing power and take that first calculated step toward building your own generational wealth today? Thank you so much for joining me on this explainer, and hey, happy investing.